Welcome to another episode at Economics Design. Last week, we talked about token bonding curves, trying to understand what token bonding curves are, and trying to get a conceptual understanding to how the shape of the curve affects the different design mechanisms and incentive mechanisms that you have in place. With that out of the way, now we can look at the different applications and case studies to understand the thought process behind all these different designs. Before I get started, I want to address three different things. The first one is, Saurav asked, can you show a tutorial of how companies decide their maximum supply? Is there any hard science and process behind it? So I want to answer this with, it depends. It always depends. It depends on what kind of functions you're looking at. It depends on why are you using token bonding curves. It depends on the entire purpose of your ecosystem. It depends on the incentive mechanisms that you have in place. So for example, if you're talking about an automated market maker, if you're talking about decentralized exchanges, then you don't have total supply. It just moves and changes according to the amount of liquidity and the depth of liquidity you have in your ecosystem. If you're talking about, let's say, equity, you're having tokens as a form of security, as a form of equity to your company, then you need to have a maximum supply because then the amount of shares that you give out or the amount of tokens you give out have to correspond to a total of 100%. So that's where you need to have a level of maximum supply. If you're talking about a one-to-one exchange, one amount of token being added into your collateral and then you can take one token out, you don't need a maximum supply for that. Or if you're looking at you're looking at creating a course. So you're doing a research or starting a company and then you have a hard cap of the maximum amount of money you want to raise, because the equity will be distributed accordingly, then you can also embed that in. So honestly, there is no hard and fast rule to defining the maximum supply, or even if there needs to be a maximum supply. It really depends on a lot of different factors. The second person said, yeah, it'd be interesting to plot some of the current top cryptocurrencies token bonding curves. So I have done a few of them. The thing I want to note is that not every cryptocurrency use a token bonding curve. Token bonding curves are really part of the incentive design or these mechanisms in the ecosystem. You could have a token bonding curve attached to a token for equities or for different types of security-like token functions. It could have similar functions to fundraising. It could have a lot of other interesting functions, but not every cryptocurrency has a token bonding curve attached to it. And number two, not every token bonding curve will be correlating to the price of cryptocurrencies, because this week's example, we're going to do a deep dive into automated market makers. So your decentralized exchanges, and sometimes they just don't have their own native tokens. So if you don't have your own native tokens in all your different ecosystems, then your token bonding curves really just help to aggregate information and help to enable trade between your buyers and sellers instead of following a book to be matching orders. So that is something to note. Not every cryptocurrency have a token bonding curve. And lastly, something that I want to mention is that last week I talked about how the log function, so the third math function that I explained, is usually involved in the input of the function and you don't really see it in the output of the function. I do want to correct that because I was looking through my notes again this week and I realized that that's not true. Depending on your incentive mechanisms that you want to embed into your ecosystem, you have different shapes of the curve. So this is one example that is shown, and it uses a log function. So you can see that it increases very steeply at first and then the increase reduces. So it gets less and less steep. So the increase in token prices is less steep as the amount of tokens are available in the market. And this function is created because the main objective of this token is to give the investor a level of certainty that their token price will increase by X%. So because that token is designed in that specific way, then you have this output. You have a log function as an output. So I want to correct my mistake saying that log functions are always in the input of a model. that's not true. Log functions are in the input of a model and they're also in the output of the model. So you can see log functions in a lot of different use cases. Once again, these are all little building, like Lego bricks. Lego bricks not just in DeFi, but Lego bricks in the whole economics design or crypto economics when we're talking about designing all these little ecosystems. Just pick and choose what works for your ecosystem, what works for your objective, and what works for your different incentives that you want to embed. There's no hard and fast rule. It's just an understanding. You just first need to get an understanding, the conceptual understanding of how they affect your incentives, how they affect your objectives, then you can play around with it. So last week, we covered the general idea of token bonding curves, giving you the explanation, the properties that you have to think about, or the properties that are being embedded in token bonding curves. This week, we're going to apply them in the different use cases. I wanted to add more use cases, but I realized that there's a lot to cover, so I'm just going to stick to two very simple ones. The first one is a pegged token, very easy and straightforward. The second is very interesting. It's the automated market maker in decentralized exchanges. This is where the whole yield farming comes in, or more like this is where yield farming is an incentive towards this underlying token bonding curve. And just to give you an understanding of how you can apply it to your project. So in this episode, we're going to uncover 4 different case studies, understanding the math behind all the different curves, and understanding how you can apply them into your project. There was also a comment saying that it's a bit too difficult, so I apologize for that. I will try to take the math out now, and I will give you the conceptual understanding because I think that it's more important than deep diving into the math. Because the math can only make sense if you understand the conceptual reason for using this math. So we will talk about the general idea first, and if you want to do any deep dives to any of the math, just let me know and I can do a deep dive to that. But from now on, I'll try to make it a bit easier to understand, to grasp the concept, so you as project designers or you as investors understand what you're signing up for or understand how you're designing your different projects. So let's get started with the different kind of token functions, because based on the token functions, you have the different types of application of token bonding curves. So I talked about this a while before. We have, to sum up the functions, you have 4 of them, sums: security, utility, money, and stable token. Security really represents an underlying asset. So think of it as a financial security and not security as in cybersecurity. Utility is where you're using it as it's an internal token. It's used for the ecosystem. Money is just money, it's currency. And stable token, it's not really so much a stable token, it's more of like pegged token because you're pegging it to something. So for example, you have BTC and Rep BTC. You have ETH and Rep ETH. You have USD and USDT. It's pegged to something else because they're using it as collaterals. But it's weird to have SUMP, so I just changed it to stable token, so it's SUMS. Based on that, the token bonding curve can be used in the different types of token functions. In securities, they can be used as a way to look at continuous funding, continuous organization, and think of it as, when companies exist, just traditional companies in the financial market, when they exist and they need to fundraise, they can always go out to investors to fundraise. Instead of going out to investors, now you can do it with a token bonding curve. With utility, it's more of you can embed the token bonding curve into your utility token so that your token has an internal price value to its worth. Or the price value can be a way to be allowing for different exchanges within your ecosystem. We'll talk about that a little bit later. For money, it depends on how you want to use it, but I would say the specific category of money will be the pegged token. And with pegged token, you can always use a token bonding curve in a very, very simple and straightforward way. So let's see. Let's start with pegged tokens, which is your stable tokens, stable coins. Stable tokens pegged is really simple. It's Y equals X because you're pegging it 1 to 1. 1 BTC, and you can do a rep WBTC around it or synthetic BTC around it. So it's a 1-to-1 peg. Because it's a 1-to-1 peg, the function is really simple. It's Y equals X. That means for every BTC that you add into this curve will automatically mint a synthetic BTC or a rep BTC for you. And that BTC will go into the collateral that goes into the area under the curve. So that's how it works. It's very simple. It's very straightforward. But the thing is, it's so straightforward. And what kind of value add the token bonding curve is bringing? What kind of economic value is it bringing? It's not bringing much, right? It's very simple, it's very easy. It's not adding so much value, but it does help to increase efficiency because you don't need humans to do that. You can run it with code, you can replace that human to do something else that adds economic value. So the economic value that we see over here is not that strong. So what are the other ways where we can see token bonding curve being a much stronger economic value, a much stronger use case in the system? I drew two circles. One is a utility circle, the red one, and one is a security circle, the blue one. And in between, they overlap. They overlap because right now, I don't really know how to place it, but there's some areas where they overlap, where token bonding curve can add value, can add economic value to these kind of token functions. So with utility, we're going to look at automated market maker. They're very interesting, very beautifully designed, absolutely beautiful. So we'll talk about that later. As for the overlap between utility and security, that's where fundraising comes in, because you can fundraise for utility tokens, you can fundraise for security tokens. There's a huge overlap. And that's where we'll talk about fundraising. But I don't have enough time to talk about fundraising in this episode, so I'll talk about it in the next episode. In this episode, I just really want to focus on automated market maker, which is in a utility function. I have not seen a lot of use cases when it comes to security, like security functions, token security functions, that it's not related to fundraising because it's usually related to fundraising. So let's get started with automated market maker. Let's talk about bonding curves in automated market maker. Before I start, I really like to do the who, what, when, where, why, how, because it gives a very good general understanding before we dive deeper into the more nitty-gritty details. So what is automated market maker? It allows users to exchange token A for token B. So I've got two different tokens and I want to change them. How do I change them? Instead of going to the order book and tell the order book or tell the exchange saying that I've got this amount of tokens, I want to exchange them for this amount of tokens, you just go to the automated market maker and you can do it with the code. You don't have to wait for anyone. The code is working 24/7, 365. Why? Once again, because it reduces human involvement and it streamlines business logic. Right now, we're just talking about really basic exchange of tokens between token A and token B, but we can expand that super easily to getting information from Oracle, to looking at how to arbitrage different prices based on the different oracles. There are a lot of ways to streamline business logic with token bonding curves because it's all automated. And where can you find automated market makers? You can find them in decentralized exchanges. So centralized exchanges will be stuff like your Huobi, your Binance, and decentralized exchanges will be stuff like Curve, Balancer, Bancor, Uniswap, all these stuff. This is where things get a lot more interesting because in a decentralized exchange, you don't have anyone controlling the protocol. You don't have anyone controlling the system. Everything is transparent. Everything is owned by the community. So that's where things get very exciting and very interesting. Who uses them? As I mentioned, Bancor, Uniswap, Curve, Balancer, these are different projects that use them. A lot more are coming. And the fun thing about bonding curves or about decentralized exchanges is that it really thrives with network effects. Network effects not in the sense that a lot of people are trading. I mean, that helps as well. But network effects as in the amount of depth of the liquidity that is being provided. So the amount of liquid tokens are in the system so that people can trade. If you don't have enough tokens, if you only have 1,000 tokens and someone comes in saying, I want to trade 5,000 tokens, then you just don't have enough liquidity to support that trade. So this is where network effects of liquidity provider comes in, which is very important for your ecosystem. And it's also used as part of the architectural stack to enable trading in DeFi. So instead of going out asking someone, anyone wants to trade with me, or going to exchanges to wait for someone to trade with you, you have things being traded with you just like that, with the machine. And how do we do it? We do it via math. So why decentralized exchange? If we look at price discovery mechanism as a spectrum, price discovery mechanism, you have very hard price discovery, so it's very difficult to look for prices. Imagine 100 years ago or 50 years ago, you want to take a plane, or you want you want to go from Singapore to London. It's very difficult to find the price, the cost to get there via plane, via ship, via bus and trains and stuff. It's very difficult. Today, we get to streamline price discovery very easily with Google Flights, with Skyscanner, with Kayak. All these different ways helps us as users of the system to find out what's the best price for me to get from Singapore to London. So in the same way, price discovery is available in the financial market. It's especially important in the financial market. You have some products that just have very hard price discovery, stuff like OTC trade, because OTC trade is over-the-counter trade. And if you want something, I'll look for it and then I trade with you. It's on-demand kind of trade. You have mutual funds, you have hedge funds, they're a little bit more secretive, it's a little bit more difficult to get the information. Then things that have easier price discovery will be like your centralized exchanges. So your S&P, your NASDAQ, where they list all the different companies and their share prices. So that's transparent. That's information that's available. I would say that it's not easy price discovery because there's some information that is still kept within the company, is still kept within the management. You just don't know, right? So that's in the middle of how difficult it is to find. And lastly, what is the easy way? The easy way is decentralized exchanges. Why? Because everyone has the kind of transparent information. The math is clear, it's out there, it's auditable, it's audited, it's hackable if you want to call it. It's all out there. Then there is no one hoarding information. The information is translated into trade volume, into price of assets or price of tokens. So it's a little bit more transparent, or it's a lot more transparent, and that's very aligned to the whole philosophy of decentralized finance. So decentralized exchanges help with price discovery. And how do we do that with price discovery? We do that with the token bonding curves, with the math of token bonding curves. Take a step back to understand what's the timeline of the development of these different DEXes, decentralized exchanges. We have Bancor being the leader. Bancor started in 2017, and they are the first one to use token bonding curves, this form of token bonding curves, to be included in their automated market makers. And they basically define a lot of these design structures of token bonding curves in automated market makers, or AMM. And then we have Uniswap that came in 2018. Then we have Balancer in 2020 and Curve in 2020. These are the 4 projects that I'm going to go deep dive into and to give you an understanding of how AMMs are being used in all these different projects. At the end of the day, it's all the same purpose. We're using AMM to allow for trade between token A and token B. So just allowing for trade. But the way AMM is used, the kind of economic value that AMM gives to the ecosystem, they're quite different. So we're going to talk a little bit about it today. And a little bit more about the math before we go in. So the important thing about the math is that there's this thing called invariant. Invariant is just a constant that doesn't change. Like it's called constant. And the thing about this beautiful math of AMMs, which is a little bit different from the other token bonding curves, is that it has this very interesting effect of something being constant. What do I mean? So this invariant concept came from the idea of energy conservation law. So first principles in energy conservation, which is physics principles, we should always go back to first principles, is that energy cannot be destroyed or cannot be created. It just transforms from one energy to the other. So right now I have potential energy, like gravitational potential energy. And if I hold a ball, there's gravitational potential energy. And if I drop it, then the gravitational potential energy goes down, but the kinetic energy and the heat energy from friction goes up because it's moving. So energy transforms, but the total amount of energy is still the same. So that's what constant means. The constant that we're talking about here, the invariant that we're talking about here, is that the total remains the same because that's a constant. The ball at this angle, or the ball at this height, and the ball that is on the ground, or the ball that's falling and moving towards the ground, the total sum of energy in each state is the same, but the distribution of energy, the amount of energy, which proportion of energy goes to which kind of energy, it's different. So that's what we mean by a constant, an invariant. This first principle is now being applied to token bonding curves in this aspect of automated market makers. And this is a function that is very important that we're going to talk about in all the different case studies that we're going to see later. Why do we want an invariant? Well, firstly, because we said that humans are not involved anymore, or humans have very little involvement. Robots will be doing the job. Robots will be executing. So you want some form of rules that robots can follow. And the robots are super smart at aggregating information that comes in. But you want them to follow some form of rules. And the form of rules is that there needs to be a constant that the robot has to follow. So when the robot is getting information, trade pricing, order pricing, oracle pricing, they know that they have to follow this invariant, this constant rule, this constant variable that they have to follow. And that's how they can execute them well. Of course, there is nothing in the world without trade-offs. In economics, there's no such thing as free lunch. There's always an opportunity cost to it. So what is the opportunity cost that we're talking about here? We're talking about the trade-off between price perfection versus predictability. With this mechanism, we don't really have price perfection because later you're going to see that there will be stuff like price slippage and a lot of other things that it's not a very efficient market, but that's where perfection comes in. But we have predictability because we can predict knowing the shape of the curve, knowing the math that's involved, we can predict that this is the expected value that we can receive, or this is the expected state the ecosystem or the AMM will be. So that's a little trade-off that we have to accept. What makes an AMM a good AMM or the best AMM? First, you need to have increased liquidity, and second, you need to reduce slippage fee. Together, they will make the trade a lot more efficient. So increased liquidity is what I mentioned in network effects just now, where you need to have enough liquidity, enough tokens so that people can trade in large volumes. And by having that a large volume, then you will reduce slippage fees because of how the math is calculated. The math is calculated based on the total amount of liquidity there is in the pool, which is your denominator. So the bigger the denominator, the less impact that your trade will create. So you want big liquidity, you want strong liquidity. So your fraction, the base will be very, very strong. So if you think about a pyramid, the base is very large compared to the top, so it doesn't topple easily, as opposed to the opposite of a pyramid where the bottom is very thin and the top is very broad, then it topples very easily. It's the same concept where when you have increased liquidity, then you're increasing the size of your denominator, so your pyramid is a lot more stable. And if you have a small liquidity and you have a big trade trying to come in, then it's the opposite of a curve, opposite of a pyramid, and your denominator is so small, your numerator is so big, then it just topples over and then it just messes up your system. Let's start with a general bonding curve for automated market makers. Firstly, you have to think about liquidity pools. I keep talking about liquidity pools. That's why everything about DeFi, everything about yield farming, it's all about liquidity pools. LP is being trended everywhere. Usually it used to mean limited partners, and now it means liquidity providers. We're looking to increase the size of liquidity pools so that it can reduce slippage fees and increase efficiency in your ecosystem. Then we also need to have a variant. So we need to have deep liquidity. We need to have a variant, which is a general constant. You define the constant. You as a creator define the constant. We're going to talk about constants later and this invariant, but basically you will define what a variant or your invariant is in your ecosystem. And lastly, what does this AMM represent? Remember, in token bonding curve, we are looking at defining the relationship between token prices and token supply with this math function. In AMMs, once again, the token bonding curve or the bonding curve is used to talk about the relationship between two different things. But what are the things? It's the relationship between two different tokens. So token A and token B. So this math model will shape the different relationships between token A and token B. Of course, you can have multiple tokens and token A, B, C, D, E, and you have a math function to correlate or to share the relationship between these different tokens. I want to go back to first principles because I think first principles is super important. And if you look at first principles, we go back to the first principles in physics. We have a hydraulic system, a very simple hydraulic system. This, by the way, is how the brakes in your car works. When you have liquid inside, and when you press down on one of the vaults or one of the opening, the liquid doesn't change in volume or nothing changes. So it will result in the other opening to increase because the amount of volume is the same. So when one goes down, the other goes up. So if you think about it in the context of the decentralized exchanges, in the context of AMMs, it's basically something like that. When you're withdrawing tokens or when you're adding tokens in, it changes this left side hydraulic opening. And that will result in the right side of hydraulic opening to increase or decrease depending on your action. We're reducing the token on the left side. So now the left vault goes down. And this means that there will be an increase in the right side. It goes up. We're going to talk about that a bit later, but I just want you to have this first principle understanding of how bonding curves are being played in AMMs and how are they being used in decentralized exchanges. So I just want you to visualize that this liquid that you see in this simple hydraulic system, that's your math function. The math function helps to balance between these two openings, token A, token B. One is affected by the other. So one goes up and down, the other responds equally. And the response is, in physics, that response is based on the liquid that's inside the system. But in token bonding curves, in crypto economics or in DeFi, this liquid is actually your math function. That's pretty interesting, right? We get to apply first principles into all these little systems and economics that we're designing. When we get the first principles right, then we know that these systems that we're building, it's going to be a lot more sustainable in the long run, a little bit more robust. And now we'll move on to the different case studies that we'll talk about. Let's get started with Bancor, the first use case. I wrote about Bancor's token economics paper, and it's available on economicsdesign.com under research. You can find the token economics paper if you're interested. Bancor is basically the first automated market maker in the space. And since then, they have pioneered this use of automated market makers for decentralized exchanges, and a lot of other DEXes are using it. They define the key conversion ratio for all these different math models in DEXes. What is Bancor? Bancor is basically a decentralized exchange, and it doesn't only work on ERC20, so not only on Ethereum, but cross-chain, like EOS and other blockchain protocols. Instead of using a token like Ethereum to allow for trade, they have their own native token, BNT. BNT basically is the common denominator of all these different liquidity pools. Let's take a step back to understand what they are. Liquidity pools are basically these token pairings that's available on Bancor. And so you can imagine, if I have my own token, so there's Lisa token and Bancor token in one pool, and then you have Economics Design token and Bancor's token in another pool. So the common denominator between these two pools is Bancor. So if you think about the hydraulic pressure that we talked about just now, the simple hydraulic system, you have this liquid and this system. So one system is Lisa's token, and the other system the other exit is Economics Design token. And the liquid inside that facilitates the trade, that's Bancor. Bancor is embedded into the math. Bancor's system works because there is a common currency that is available in all the different token pools, which is BNT, the Bancor's native token, and allows it to facilitate trade within all these different systems. It works in a very simple way. It's like a hub and spoke model. An analogy would be planes. For example, you want to fly between New York and Hong Kong. And between New York and Hong Kong, the flights are full or they just don't have the connection. So what you do, you fly first to Chicago, and from Chicago, you fly to Hong Kong. So this thing where you fly to Chicago, that thing is basically BNT. So how it works, if I want to change New York tokens to Hong Kong tokens, I first go to BNT token, I first take my New York token to exchange for BNT token, and then from BNT token to exchange for Hong Kong's token. So in a bigger picture, that's exactly how Bancor works. Bancor is the common denominator, BNT, to allow you to access to all these little pools available. Of course, you don't have to manually go and trade with it. It has a lot of systems built in place. You have different liquidity pools to allow you to access liquidity very easily. This is a very good system as well because it allows for interoperability between the DLT layer 1 platforms, because Bancor is built as a layer 2 application to allow liquidity between different kind of tokens. For EOS, you have this thing called Dragon token, and you want to exchange it for BAT, which is an ERC20 token, or DAI. How do you exchange that? You can do it via Bancor because Bancor has a system to solve the interoperability problem. But I don't really want to talk about what Bancor is because you can find that online. I want to talk about the math model in Bancor. Bancor uses this ratio. So if you want to model it out, it looks like this. And it's the price of the liquid token, so price of the Lisa token, equals to the volume of the reserve token, so let's say DAI or BNT, divided by the supply of liquid token, so supply of Lisa token in the pool, times the reserve ratio. And remember we talked about invariant, we talked about the constant that is available, the constant that is always there in all these AMMs. The AMM in Bancor itself is the reserve ratio. The reserve ratio is 50-50, so 50% BNT token, 50% this liquid tokens, and this is how the model looks like. There is a lot of consideration going in to talk about how the price is derived, how much tokens will you get out when you put in collateral of the reserve tokens and all that calculations. It's available in the research paper that I wrote. The interesting thing is that this reserve ratio is changeable. It's not fixed. So right now, that was in Bancor V1. Bancor V1 is where the reserve ratio is 50-50. So that means 50% is BNT, 50% is Lisa's token. But right now in Bancor's version 2, it automatically allows the reserve ratio to change. There's a lot of math going on behind. I just want to simplify it a little bit more. We take back the analogy just now of the hydraulic press. The hydraulic press in Bancor's version, or in version 1, you have 50% Bancor's token, BNT token, 50% Lisa's token. So it's 50-50. And if you can imagine a line in the middle of the hydraulic press, then the line in the middle here will show a 50% split. Now, what happens when there's a trade in price? So Lisa's token increase in value, and now this simple hydraulic system is not a 50-50 split. And this is where arbitrageurs will come in to balance it up again. But in this process, me having my Lisa token in this pool, I will have some losses because of the price difference, price movement, and stuff like that. If you're interested, I can do a video on that. But right now, just understand that when the value of one of the token, if the value of Lisa token increases, then it will mess up this 50-50 ratio that I'm looking at in the hydraulic system. And so what Bancor's V2 does is that you see this invariant, this reserve ratio that we have, initially is invariant, which is 50-50, 50%. So it's always stuck at 50%, 0.5. But right now, it allows it to change just slightly for a short period of time to make sure that balance will come back again. And I can explain that in the future video. Just let me know if you want. It will be a little bit technical, just a little bit. I don't want it to be too technical for this one. Basically, the reserve ratio allows the AMM to adjust a little bit during the short time frame when arbitrageurs come in to level out the ratio to 50-50 again. At the same time, the people who have the money inside Bancor doesn't lose out. So this is how AMMs can be so dynamic, because it is not just a fixed ratio. We talked a lot about having a fixed curve, but this fixed curve has a lot of variables in there that allows for change, allows for additional input, additional dynamic changes based on whatever that's out there in the market. The second thing that I want to talk about is Uniswap. Uniswap is similar to Bancor. The only difference is that Uniswap is only for ERC20 tokens, so only for Ethereum tokens. And now, if you think about it, it's only for Ethereum tokens. So do they need their own tokens? No, they don't. They just use Ethereum as the main denominator to transfer tokens between all these different pools. So with Bancor, you can't do that, because with Bancor, the tokens that they have is not just ERC20. It also talks about different kind of tokens like EOS and other different platforms. So you can't really have Ethereum to be your main denominator, because this Ethereum doesn't work well in EOS pool, for example. So Bancor has its own token BNT to allow interoperability between all these pools. With Uniswap, it's so much simpler because they just have these token swap or these token exchanges between all the ERC20 tokens. So they don't need their own tokens, they just use Ethereum. The fun thing about Uniswap is that it doesn't have oracles. In Bancor's V2 model, they are adding Chainlink's oracles into that to be providing the information as like price news feed. With Uniswap, there is none. And with all these different DEXes, right, this decentralized exchanges, the cool thing of why they exist is that with centralized exchanges, you just trade the top 10 or top 20 coins or tokens that's being used. But the thing about tokens that exist is that we have this thing called the long tail phenomenon. If you look at this graph over here, you have this green thing, which are the things that's traded very frequently, and those are available in on the centralized exchanges. But the yellow one that you see, those are the long tail. So they don't have such huge volume, but people still want to trade, people still want to use them. It's not worth it to be listed on these centralized exchanges like Binance and Huobi. It's very expensive. So they have all these DEXes to allow for exchanges between these long tail tokens. I saw someone comparing DEXes to liquidity provider of first resort, which is quite interesting because in the real world, you have central banks as the lender of last resort. What does it mean in the real world? In the real world, it means that if everyone stops lending you money, the central bank will still keep lending you money because they are the lender of last resort. In the DeFi world, things have swapped a little bit, Uniswap, and it's a liquidity provider for first resort. What does it mean? When your tokens are in the long tail, so Lisa's tokens, not a lot of people are going to trade. It's not going to be listed on Binance, but a few people want to trade for some reason. And then I can provide liquidity by having a Lisa token pool in Uniswap, and I am the first provider of the liquidity. So liquidity provider of the first resort for Lisa token. And you can do that in all these decentralized liquidity pools. With Uniswap, things are a lot simpler. It's a very simple model. They call it the constant product market maker. So it's K equals XY. So X will be token A and Y will be token B. So they use R alpha, R beta. And if you see this model, what I want to show in this little video that you see over here is that the curve changes. So the curve, remember we talked about how curve doesn't really move? The thing is, the curve itself, the curvature doesn't move so much, but it can move in and out. What does it mean? If you look at this video again, what you see is that the curve keeps shifting outwards. When the curve shifts outwards, it means that there's more liquidity being added into the system. But the curve doesn't really change so much. It just shifts outwards, and that's because you have liquidity from different, like either token A or token B in there. Remember we talked about the idea of invariance. So nothing is created or destroyed. Everything is transformed from one form to the other. So that green box that you see, I can translate it to this little curve that I drew, and 3 different colors. So if you imagine the colors go all the way through, so they're not overlapping, the entire orange versus the entire blue versus the entire purple, these are different colors of the area under the graph. What does it mean? What does it mean by the area under the curve? The area under the curve shows the amount that you receive by swapping one token for the other. And you can see that by swapping different amounts, you get different exchanges in the tokens. But the cool thing is that if you calculate the different boxes, imagine they don't overlap and they go through, the ratio is the same. Why? Because according to the conservation theory, the first principles in physics, nothing gets destroyed. It just changes from one form to the other. So it, once again, goes back to this constant product market, the Uniswap's formula of K equals token A times token B. So the area under the curve will still be the same because nothing gets destroyed or created. Everything whenever you change from token A to token B or token B to token A, the amount change is the same, provided the curve doesn't shift, of course. If the curve shifts because there's additional liquidity, then the area under the curve will be different. But if everything stays the same, the curve is like that, and if you change for any amount, then the sum of the amount changed will be the same. Let me know if you need further clarification. The third one that I want to talk about is Balancer. Balancer works in the similar way, and with Bancor and with Uniswap, you realize that each liquidity pool only has 2 tokens. With Balancer, it's a bit more interesting, it's a bit more complex. It has 8 different tokens, or it can contain up to 8 tokens. So it's a more complicated version of bonding curves. They call it nth dimension. So I can't model it in 2D, but I can show you what it means later. Balancer is an ERC20 tokens, and you can adjust a lot more things because the math is just a bit more complicated, because the system is a bit more complicated, but the fundamentals is still the same. The fundamental is that you have this mechanism that shows you the relationship between all the different tokens, how they interact with each other, and when one increase, it has like either auto rebalancing, which is what you see in automated market maker. They have rebalancing, or they have a way to balance the different token weights, or you can get to choose them. In Bancor and Uniswap, you can't really change the weights. Everything is either fixed or done dynamically. With Balancer, you get to choose a little bit more. You get to adjust the tokens. So as I mentioned, your pool. So imagine going to picnic and having a picnic basket. And to go for a picnic basket, you can choose up to 8 items. So you can choose to have bread, strawberries, chips, drinks, cheese, wine, and there's 6 items. So I have 6 items in my basket. In the same way, Balancer also works like that. In a pool, you get to choose up to 8 different tokens. And then you as the owner and anyone who wants to join your pool has to provide those tokens into this pool. So this huge picnic basket that everyone gets to put the items in. First, so as the owner, you get to decide, okay, these are the 6 items I want in my picnic basket. You want to come to picnic with me? Then you put the items in as well. Then we can go picnic together and we can share. So that's one. You get to choose your tokens. The other one, you get to choose your token weights. So if our picnic basket is smaller, we just have 3 items. We have bread, wine, and cheese. And maybe we don't want to have 2 bread, 2 wine, and 2 cheese, because that's too little cheese, too much wine, or good enough wine, and too much bread. So you want to have maybe 10 cheese, 1 wine, and 2 bread. And so you get to choose the different token weights. That's what Balancer does. You get to choose your different token weights. And then you get to choose transaction fees as well. So anytime, because Balancer is a pool, this picnic basket pool, right? And anytime someone wants to take cheese out to consume, to eat it, and to use it somewhere else, then they have to pay a transaction fee. And you get to choose this transaction fee, high or low. The idea of Balancer is to be a portfolio manager. So instead of managing a portfolio in the financial world, you have your picnic basket as a portfolio, and inside you have the different kind of assets in your picnic basket. You get to manage it, and the math will help you to do some form of rebalancing. So this is what the math is. It looks complicated, but it really is not. It's a sum of amount of tokens. So it's the sum of the tokens multiplied by the weight you give. I'll explain it a little bit simpler later, but just understand that there is this thing called the invariant is the V that you see over there. The invariant is where the sum of the invariant balances the sum of all the tokens available. So in Uniswap, you have K equals XY, right? In Balancer, you have V equals, X times Y times Z. And you can change the weights of that. Let's not talk about that first because it's going to be unnecessarily complicated. Let's understand what it means by K or V equals X times Y times Z. So what I have over here, for some reason I can't model a 3D curve. So I took an image from Google, and this is a 3D curve. You see the 3D curve has 3 different axes. So you have axis X, Y, and Z. And from there, it shows you the different curve. If you look from a 2D angle, you can just see the relationship between X and Z, or you can just see a relationship between X and Y, or you can look at the different angles to understand the different relationships between the two tokens. But at the end of the day, all these three tokens are connected in a specific way. This specific way is this V that you see over here. So instead of a 2D curve that we see in Uniswap like this, we see a bit of a 3D curve, and this 3D curve is this V. So previously in Uniswap, we have this one curve only. That one curve, we call that K. That's the constant. With Balancer, it's a bit more complicated because it's 3D or 4D or 5D depending on how many tokens you have in place. And that curve, which is fixed, is called V. Of course, this V can change by having more liquidity, so the curve moves out or in. But the concept is that it's constant, it's fixed, it's the invariant. Why is it important? Because when you have increase or decrease in one token, then it affects the two other tokens. And the robot, the smart contract, this is the rule that they will have to play by. This is the invariant, this is the curve, this gradient curve, this colorful curve that they have to follow, they have to exist on the panel of the curve, depending on how you want to place your X, Y, and Z axis. So this is just the very basic understanding first of what Balancer's protocol is, to give you an understanding of how different token assets can affect the shape of the curve, the visualization of the curve. Which brings me to the last project called Curve itself. So if we think of Balancer as having a lot of different tokens and giving different weights, the idea of Curve is similar, but instead of X, Y, Z being different tokens. So X could be DAI, or in the picnic basket. In the picnic basket for Balancer, you have wine, cheese, and ham, or wine, cheese, and bread. In Curve's picnic basket, it works the same way, but in Curve's picnic basket, they are all similar assets. So this Curve's picnic basket is got cheese. So you have, camembert cheese, brie cheese, Gouda cheese. You have different kind of cheese that is in there, but at the end of the day, they're all cheese. So in the DeFi language, it means that all of them represent a very similar asset. So it could be USDT, USDC, True USD, DAI, and Synthetic USD. All of them in this USD picnic basket, and that's managed by Curve. So Curve basically does similar stuff as Bancor, but the difference is that they only trade assets with almost similar or same valuation. So you basically just want to trade between assets. So if I have USDT, I don't want USDT, I want DAI. So I can go to Curve, go to the picnic basket in Curve and say, okay, I'll give you USDT and give me your DAI. So that's what it does. Why is it good? It's good because it has low slippage. Once again, another technical episode. So if you want to understand what is low slippage, how to reduce slippage fees or slippage pricing in the modeling, let me know so I can do one for you. But I realize that I will not throw too much math in your face because you didn't ask for it. And I'm not going to confuse you further. Just want you to understand how things work. Just having a conceptual understanding. So this works very well for stablecoin. Now, Curve hasn't released its white paper yet. It showed a little bit of the master math that it has, but it's going to be edited because of some, the I not equals J part. It's a bit of bug with which they have fixed, but they have not released it yet. So once again, you have token X, token Y, token Z, and then the curve just shows the relationship. So the curve function, that's the rule. So when there's any trade happening, then the robot will know that, okay, no matter what I do, I have to follow the rule, I have to follow the curve, I have to have a new point on the curve based on the new ratio in this picnic basket. In Curve, the invariant is defined in that way. And what does it mean? It means that this rainbow curve that we see over here, that's the rule that the robot has to play by. So when I deposit USDT into this USD picnic basket and I take out DAI, then it understands, okay, so that means, for one of the axes, there's less in it, less quantity, but the other token increase in quantity. So now where do I pinpoint this new intersection on this rainbow curve to show the relationship of the value of all the tokens in the curve? it's quite similar to Balancer. There's differences in the math model, but we're not here to deep dive into the different math models. We're here to understand the conceptualize what all these math means, all these different aspects mean. So how do you apply it to your project? This is where I want to go a little bit. This is where I want to spend a little bit more time, because this is where it makes sense to understand why the hell are we deep diving in all these automated market maker. So if I can summarize, we are looking at two different types of models here. We have the first one is x times y equals k. K is the invariant. K is the constant that we're looking at. And when we have two assets, we generally are looking at a 50-50 split, because it's fair. It could possibly change a little bit, like a dynamic different weights for a short-term period to prevent some form of losses in the trade. But the idea is that we have two different assets, the weightage is 50-50, and that's where you get your constant. The other thing that we talked about today is when the asset has more than two tokens. So let's say 3 tokens, X, Y, and Z. And it could have all the way up to 8 tokens as we have seen in Balancer. And the weightage now is more interesting, because with 2 tokens, you just have a 50-50 split, right? When you have more tokens, then you change the different ratio. It could be A, B, C, it could be 0.5, 0.2, 0.3, but the sum of A, B, C has to be 1, which is what we see over here as well, because the sum of them has the sum of these two numbers, they have to add up to 1. This is something that is quite important, because if you don't add up to 1, the formula just doesn't work. And the cool thing about having dynamic weights is that as the creator of the pool or as the owner of the pool, you get to define the different weights. And these weights are the rules to live by, and they define the different curves that we talked about a lot just now in the different visualization of curves. If I can summarize what we have talked about today, it's to look at 4 different functions of how AMMs can work in DEXes. We also look at the invariant concept K. K is something that's fixed, something that is constant. And you can see that although they are all AMMs, they're all working in DEXes, the invariant concept is different. So with cross-chain functionality, we have K equals A. A is the value of this reserve token, or the value of the native token, which is in Bancor's case BNT, divided by the supply and the price of the other token that you're exchanging. So let's say Lisa token. So this is K is the constant, the constant value, and that's the ratio between the market value of BNT versus the market value of Lisa tokens. So that's K. What assets are we talking about here? You have 2 assets. You have 2 tokens. One is a native token and one is some other token. So native token will be BNT and some other token will be, let's say, Lisa tokens. And that would be the example of Bancor. Of course, in this example, you don't just trade between Lisa token and Bancor. You more likely want to use Bancor as an intermediary to trade Lisa tokens with something else. So Lisa token with DAI. But there is no Lisa token and DAI pairing available. So you have to trade Lisa BNT DAI. And that's how you indirectly trade for Lisa and DAI tokens. So that's what Bancor does. So it allows for cross-chain interoperability. The second one is where the function is just the same chain. Do you need a token? No, you don't need a token, because if it's the same chain, then there is already something that connects both of them together. So in Ethereum's case, it's usually Ether or ETH. Why do we not want to create a new token? Because then you need to get liquidity for that token. You need to get network effects for the token. It's just a lot of unnecessary hassle. You want to get something that's already in the market. With this, a very simple concept is K equals X times Y. Technically, it's K equals, if you look at the model, it's just K equals XY. But I just want to show you what the weightage is. So I put a 0.5 and a 0.5. Mathematically, because K is a constant, so you can put K equals XY. But I just want to show you that, there's a 0.5 weight balance in these two tokens. So what assets are we talking about here? We're just talking about two assets. You have another function. We talk a little bit more complex functions. So you have assets with different values. That's balancer. So it's a bit more of a portfolio management, but you have different kind of tokens with different weightage. So do you need a token? Not necessarily, because with your portfolio, you have 8 tokens to choose from. Are you telling me that you all these 8 tokens have so low liquidity that no one is trading? You don't really need a token to allow you to tap into all the other pools available, because in 8 different tokens, you have tokens that's highly traded. So you don't need a token to do that. You can choose one of these tokens to add into your pool. You have 8 spots to choose from, so you can add them into your pool. However, a balancer has their own token, but that is not so much a token to facilitate trade. It's more of a governance token and a network token, which is different from Bancor's BNT utility token. With this, the invariant is also a bit more complex. I mean, if you look at the Uniswap, right, it's x times y, both with a power. Balancer is also similar. You just have x times y times z, and you get to define the different weightage that's above. Of course, as you have x, y, z are specific tokens. So if you have 8 different tokens, then you have 8 different things, and you have A, B, C, D, E, all the way until H. And you get to choose them. And the thing is, A to H, they have to add up to 1. Not more, not less, just 1. The number of assets you can put in can be multiple assets. And because now this is a lot more complicated. Whatever that we've modeled just now is a 2D model. And now it's a lot more complicated. You need different perspectives. You need different dimensions to look at it. So you don't really model them in a curve format, as in the entire function. But we can take different functions out to analyze on a relationship between x versus y in this balancer pool relationship. And also this is where the math comes in. You have less visualization on the curve part, less about calculating area under the curve, more about integrating the curve function itself. So this is where things get a bit more complicated. That's where machines are very good at doing that, right? That's why we have machines. And the last one is the assets with the same value. So once again, you don't need a token. Same with balancer, you don't need a token, because these assets, they have the similar value, and they're also very likely to be traded frequently. And you have a similar kind of invariant concept as well. The only difference between balancer and curve is that for balancer, they can have different assets. You can have Visa tokens in there, BAT in there, DAI in there, Ethereum in there, Rep BTC in there, whatever. You can have whatever that you can think of putting in there. With curve is different. With curve is really similar kind of concept, similar valuation. So Rep BTC versus REN BTC. Similar value and similar assets almost. So that's it. I just want to summarize this in this little table. I will make this table a lot nicer so that you can share it and keep it if you want. Basically, the concept that I want to bring across is that, number one, token bonding curves can be used in a lot of different ways. Token bonding curves, one of the ways is automated market makers. Number two, what works for one automated market maker doesn't work for all automated market makers, because the algorithms for AMMs are quite different based on the different incentives, the different objectives, your different design and model of your ecosystem. I just want to stress that there is no one-size-fits-all model or formula for all the different projects available. And don't be limited to just 2 different assets. You can expand it to more and more different assets. You can model them in graph, you can model them in mathematics, but don't just limit yourself to 2 assets. I've been sharing a lot in 2D curves because that's the easiest way to get started to understand how two tokens interact with each other. But there's endless possibilities with adding more functions, adding more variables, adding more tokens in there. So don't just limit yourself to a relationship between 2 tokens. You can look at relationship between 3 tokens, 4 tokens, 5 tokens. And lastly, the important thing is that you need to have something that's constant. This constant will really define your entire ecosystem, your entire token bonding curve, your entire function. because this constant function is fixed. And when this function is fixed for a reason, because your ecosystem needs to have this kind of fixed feature, especially in automated market makers. You don't need to have this invariant concept for all different token bonding curves. That's what I want to say. For different types of token bonding curves, you need different types of inputs and variables. And in this case, for AMMs, you need to have an invariant concept. You can have invariant concept in other token bonding curves. You can choose not to have invariant concepts in some token bonding curves. It really depends. So in automated market makers, you need to have that. That's it for this week. I hope I've covered enough, given you enough understanding of how token bonding curve works in a use case, in a utility use case, in a finance context, and in this decentralized these algorithms for decentralized exchanges. There's no one size fits all model, and that's why I've shown you 4 different algorithms. I'm also going to start refilming the entire token economics blueprint course. So if you want, you can go and watch. You can sign up to the course now. You can also sign up when it's available. But right now, if you sign up right now, you get access when I've re-recorded it as well. So then I'll see you at the course. So you can scan the QR code or go to the link bit.ly/tokenomics201, or I'll see you in the next episode where I'll dive deeper into showing you how you can apply token bonding curves into other assets. So we're going to look at fundraising next. I know this video is quite long. I didn't mean it for it to be so long. There's just a lot of things to cover. That's why I've already split this into 2 videos, into utility function and this fundraising function. Otherwise, if I squeeze everything together, it will be quite difficult for you to keep up and follow up. Till then, I'll see you in the next episode. Bye!